Hello and welcome everybody to this XTB Trading Club. Thank you very much for being here with me. My name is Walid Koudmani, market analyst for XTB. And we actually haven't done one of these in a while, but in these kinds of events, we tend to go over the markets, explain some events, current events, major events that are happening, take a look at some charts, take a look at some factors that could be affecting the prices of, for example, stocks or commodities or whatever we may be trading or whatever we may be looking at. So as always, thank you very much for being here with us. Let's do a quick audio video check just to see that you can hear me, you can see the screen. I have the chat open on the side, so if you have any questions, feel free to ask them. I'm very happy to answer whatever you may have. Even if we have a little bit more time towards the end, we can even go and look at some charts on the X station. If you have any market in mind that you would like me to take a look at, maybe look at the charts and see what's happening with that, we can go even and do that towards the end. Good evening, Patrick. Thank you very much for being here with us. I see some of you are joining us, some people that we might recognize as well. So thank you very much. And, without further ado, maybe we can even get started. So once more, my name is Walid Koudmani, market analyst for XTB. Thank you very much for being here with us. Good evening to you all. It's been quite an interesting few weeks. So we had the Chinese situation last week. We have the energy crisis this week. We're going to be talking about a little bit both, along with some US issues with their debt. And we're going to be talking about really taking a focus on commodities towards the end, looking at some factors, involving, what's happening with oil, nat gas, and a couple of other commodities as well that maybe are not as followed from most people. Popa, thank you very much for your question. If you have any sort of question relating to your account, feel free to just contact your account manager or support. They will be able to help you. This is just an educational webinar where we're going to be talking about the markets, trends, what's happening, major factors, and we're going to take a look at the charts as well at the end. So if you have any questions, I like to do a Q&A section towards the end where, whatever questions you may have, we can ask and try and find an answer. If not, we can also, if something, for example, if you're stuck on a slide or something like that, if something isn't clear, please feel free to ask. I'll try to clarify as much as possible. Of course, I'm not going to be offering investment advice, but this is just, some educational content, some interesting point of view that we can all take a look at. So without further ado, let's take a look at the disclaimer as always. Yes, if you can hear me, just if somebody could say that in chat, if everything is clear, the screen, you can see that and you can hear me, we can just move on from there. So this presentation is provided for general information and marketing purposes only. Any opinions, analysis, or other content does not constitute investment advice or recommendation. Very important to keep an eye on. And we'll move on from there. So some top news for this week. We had markets returning to the buy the dip. So if you might have heard, thank you very much for the feedback, Patrick and Popa. So, you may have heard the term buy the dip. It just means that when a market falls, some investors tend to buy on the drop, expecting the market to flip around and not just continue to drop. So ideally, that's what would happen, but sometimes the market does continue to drop. So with the Evergrande situation, we saw that basically this huge Chinese developer, really construction developer, was unable to pay its debts. So it was going to default on its debts, and being one of the largest companies in the world, it was going to have huge repercussions on not only the Chinese economy but also on other global economies. So that was definitely an issue that we were following towards mainly in last week. After that situation got kind of handled, and I'll touch on that a little bit further. We also had the Germany elections, so with the SPD winning in Germany and looking to form a grand coalition. Power crisis spreading beyond Europe, which it's starting to head into Asian markets as well. And we actually had a news on the platform today just recently on that very particular topic, where now Chinese authorities are issuing an order to their energy providers to supply or to stock up on energy so that they don't run out for the colder months. So that's going to be something really worth keeping an eye on moving forward. And we also had some key data this week with the PMIs in China, flash September inflation in Europe, and PCE inflation in the US. So inflation seems to be quite the topic to follow these days. And the reason for that is really because you have this market that is sustained by central banks at this point. So I've been saying this since the, maybe 6 months into the pandemic, basically, where it looked like, every figure was really negative, but stock markets were still ramping up and recovering. But when we had like very high unemployment, very bad sales, retail sales, and other indicators as well were quite negative, we saw in stock markets, particularly in the US, continuing to rise. So now we're at the turning point of that, where that is going to have to change at some point on the end, that all this money that's being pumped by the central banks is going to have to start being tapered. So that's what the whole discussion about around inflation is. Because there's so much money in the economy, the dollar or any other currency, really, even the pound or anything like that, is worth less because there's more of it. So let's say before you could buy something for $10, now the same thing costs $12. It's not necessarily that the cost of it in raw materials went up, it's just that each dollar is worth less now because there's more of them. And that applies to any other currency with a print, basically. So that's the situation we're in at the moment. But the fear is that once the money runs out from the central bank, all of that, let's say fake move up will probably, or could be somewhat retraced on some level, because a lot of it, or some of it on some level, was not just due to the actual performance of the stocks, which we cannot doubt that at all. Once again, if you have any questions, thank you very much for all your questions. If you have any questions for, related to your account withdrawing money or anything like that, feel free to contact support or account managers, and they will be able to help you with that as soon as possible. Moving forward. So China more and more seems to have this huge effect on global markets, obviously starting with the copper, which I've mentioned in several other webinars, where China actually imports more than, or around 50% of all global copper. So that's something very important keeping an eye on if you're trading copper, China and Chinese demand. Evergrande, the story between life and death. So fears of Evergrande bankruptcy led to a rapid market sell-off on Monday, but eventually the buy dip mentality won, so we saw that flip. The company reached an agreement with local creditors on Thursday, so this is last week, of course, Thursday's coupon payments, thus avoiding a formal bankruptcy. However, details remain unknown. Nevertheless, Evergrande missed over $80 million worth of bond payments, so bonds denominated in US dollars, and entered the 30-day grace period. So they have 30 more days to come up with the money, basically. The firm has also stopped paying its employees. And this year alone, Evergrande has $669 million worth of remaining coupons still to payment. And you can see that here on the monthly interest per payment, with basically Evergrande has 669 million of coupon payments remaining this year, with the orange bars being the monthly interest payment due in dollar, and in the ones in local. And you can see a lot of them, if not the majority, are in dollars. It's not about creditors though. So we are seeing that since Evergrande is the largest Chinese borrower, obviously its bankruptcy would lead to a hefty losses among creditors. So this is something that kind of mirrors the situation that you might have heard of in the 2008 crash, where this term of too big to fail really started to pick up. I'm sure some of you may have heard of it. And the reason for that is basically that it causes a chain reaction to where everybody runs out of money, right? Because everybody's relying on the bigger companies that nobody thought could fail. That's the main part of it. So being the largest Chinese borrower, obviously its bankruptcy, as I said, would lead to hefty losses among creditors. Among affected investors, there are some large investment funds and banks. Potential losses should not lead to downfall of big institutions, though, sometimes. Risks are much more serious in China. Relationships between developers, construction companies, and banks are really strong. Evergrande's crisis may lead to troubles of many other firms. A potential domino effect could even be out of Beijing's reach. And very important to note, because this is, as I said, similar situation to before. It's all tied in, and we've actually mentioned in some articles, if you've read on the news section, that Evergrande actually, not only is it the largest Chinese borrower, but it actually manages and develops properties for, hundreds of thousands, not hundreds of millions of people. in China. So it's a huge company, like, way bigger than anything really that we've seen before, some with this risk. And that's what the Chinese government is desperate to avoid. So for now, they came up with the 30-day payment plan, let's say. If that doesn't work out, we can expect probably some intervention from China. I doubt they will let everything fall apart, but you never know with the governments these days what happens. We're not sure yet. But to understand Beijing, we have seen a lot of regulation as of late coming out of the Chinese central bank and the Chinese government. Some have been affecting tech companies. You saw some affect paid education companies. And every time we saw a reaction in the stock markets as well, particularly in the Chinese stock markets, of course. Casinos and the rest of the gambling industry, gaming industry as well is going to be affected by that, video games. And obviously the latest power curbs with the fear of some issues with supply. In addition to that, we also have the constant news of them hitting cryptocurrencies on top of that. And they've hit them quite hard. Authorities not only banned any forms of cryptocurrencies, but also said that all cryptocurrency related activities are illegal and may be seen as a crime. The perspectives of cryptocurrencies are obviously much worse without the Chinese market. The question is, how will Western authorities react, go in the same direction, or implement moderately positive regulation, thus opposing Beijing's direction? So obviously the Chinese government and the Chinese economy has a huge influence and impact. It is a huge sector, just population-wise and money-wise, but very important to see that how different governments are adapting to different things and how the Chinese government has adapted to the Evergrande situation. That's why I'm mentioning how it could be different from how other governments would react. So if everything is clear so far, hopefully it is. As I said, if you have any doubts or questions, feel free to stop me or ask something. I have access to the chat here, so I can see the chat. If not, we can move on, and we can also do, as I said, a Q&A session at the end where you can ask me whatever you want about these markets or any other markets that you might want to discuss. The topic of the week, though, is what does the Fed's decision mean? So last week we had the Fed, the U.S. Central Bank, deciding to leave rates unchanged. Very expected. Several other central banks did similar things. But this week we also had several central banker speeches. At the beginning of the week, yesterday we had the ECB forum, which was a meeting of the European Central Bank where the governors of the Bank of Japan, Bank of England, U.S. Central Bank, so the Fed, and also the European Central Bank, of course, were present and talking about their outlook for the economy and their outlook for monetary policy. Likely is the situation is getting more and more likely to where potentially they could be changing their monetary policy, which, as I said at the beginning of the webinar, could play into fears for stock markets. But as a result, obviously, if you reduce the supply of currency, it should help with inflation. That's the idea. Hello, Douglas. Thank you very much for joining us, and thank you to everybody else who just joined us or has just, I might have not said hi to. Thank you very much. Good evening to you all. My name is Walid Koudmani, market analyst for XTB, and in this webinar, we try to cover, a broad range of topics to give you an overview of the markets, and we're going to be talking specifically later on in the webinar about the energy crisis and an outlook of commodities. Yes, Supe asks, any idea about the DE30, so DAX or the Dow Jones? We're going to be talking about that towards the end. I'm sure if we're going to have a little bit more time, I'm going to take a look at the charts, and we can take a look at the charts and take a look at some indices and some commodities as well. So, and Shahid Hassan asks for gold. Absolutely, we're going to talk about that as well later on in this webinar. So save your questions if it's about a chart. If it's about something right now, feel free to ask, and we'll get to that in a minute. So, will the Fed really increase its interest rate? I hope that it's clear why it matters, why the interest rate matters. I know it can be a little bit confusing for people that maybe might not be too into the central bank policies, but really it does matter because it's these two forces opposing each other with interest rates and inflation, and interest rates really refer to a supply of money to the markets to help the recovery at the moment. So the Fed's decision does not shake the markets and turned out to be rather unnoticed because, as I said, it was expected. So the more expected a decision is, the less of an effect it has on the markets. The attention was focused on the dot plot chart, which indicates that hiking rates could be launched as soon as next year, Q4 2022. Yes, in fact, Douglas says D30 has been on a roller coaster ride. Of course, yes, we've seen a lot of moves in the past couple of weeks on indices, um, and we're going to touch on those in a minute. That's the only theory, though, as not every dot plot is equal. No one should keep in mind, one should keep in mind that the majority vote does not apply for the Fed. The role of the chairman is absolutely dominant, so he decides or she decides. In our view, Powell's dot sits in the lowest group of dots, and he doesn't see the first rate hike until 2023. So markets tend to move these days. Before the pandemic, I feel like most people did not follow central bankers and their speeches because they didn't really have that much of an impact. Nowadays, even if it's not Powell, so the head of the central bank, even if it's one of the other ones that mentions perhaps the potential of a change in the economic policy or fiscal policy, you see reactions often in the stock market because they could change his mind. Ultimately, this decision is his. And for the time being, he sees potentially the need to continue with the fiscal stimulus and with the fiscal policy that they have at the moment. Nevertheless, the Fed has somewhat suggested that QE tapering could start in November, and surprisingly, Powell indicated that the process could be finished by mid-2022. So it is not a overnight thing where, one day they have money pumped into the markets and then the next day they cut it off. They try to gradually ease markets into it so that they don't have such a shock, basically. If the Fed sticks to its plan, this could have a significant consequence for market liquidity. Of course, because, what we are seeing, we did this in a previous webinar when we talked about really the breakdown of indices and how they're weighted. So how the S&P 500 is obviously 500 companies, but they're not equal in the weighting. So how much each company moves the index. So certain companies move and matter in the index a lot more than others. And you'll see that maybe the top 20-ish companies really make the most difference. Everything else, a lot of them are really not even performing very well. So that's what's happening, is a lot of the money that might have been invested in those is going into buying stock because the price is high of companies, let's say in the top 20, boosting the index because they're the most weighted. And that's why if there was this reduction of liquidity in the market, we could see that then impacts some stock markets as well. We also have the issue of the debt ceiling in the US. So the all this printing of money that they've been doing has to be paid somewhere. One should keep in mind that the debt ceiling is likely to be raised in October. Democrats will probably need to do this by themselves, though, because obviously Republicans tend to be a little bit more fiscally conservative, and they tend to be anti, debt ceiling raising, especially when it comes to social policies. Even though they are divided on this front in terms of how to do it, Moody's estimates that the insolvency could lead to 6 million people losing their jobs and 33% bear market if they were to default. Even if the debt ceiling is raised quite smoothly, U.S. Treasury will be forced to intensify its debt issuances. So now what we're having is, after a year and a half of the pandemic, a little bit more than that, we are seeing now the debt catch up basically to the government. So in theory, because the U.S. is a country that prints their own money, they could just continuously print money, and that would ultimately devalue the currency. So the way they kind of deal with that is through issuing debt, bonds, and other ways to, guarantee the fact that this money is going to be repaid. It's not free money, and that's what's going to be happening. But at the same time, if the Treasury and the Fed and the central bank do not then agree on the debt limit that they want to issue, then we have a problem there, because then basically the government does not have enough money to function. And that's what we're seeing at the moment. We saw a government shutdown, I think, under Trump. We had one of those. I think there's been a few in the last decade. And they don't tend to completely, let's say, really, really impact markets, but they do have a huge impact on actual life in the US, particularly when they do shut down, because obviously everything that's government institution would be then shut down because of that. Yes. Okay. Next. The question, though, remains, when will the Fed stop printing? Key question: if the Fed sticks to its plans, such a scenario would most likely be positive for the US dollar and negative for bonds and stocks. So really going to play into what I was mentioning at the beginning. The lower supply of money lets the money that already exists increase in value. So the dollar itself. That should help with inflation, which the central bank, the Fed particularly, says is transitory, meaning that it will be temporary, although really they've been saying that the whole time and it's still not temporary. That's the interesting thing we're seeing, is really them playing as well with their expectations that we're seeing. Patrick, I'll get to your point. I think it's interesting. Um, However, I am not convinced that the Fed will actually end its QE at the time being. The global economy is already slowing down, even the US economy, despite enormous stimulation. Even if the Fed launches the tapering, the central bank could suspend or reverse the process. And I think perhaps partly this is what played into their ideas of not reducing it very, very fast, is this expectation of potential slowdown in economic recovery. So heading into the winter now, we are seeing some slowdown on several sectors, along with this potential, fuel and energy crisis. We could be seeing it also impact other industries, which then could slow down the economy once more. So also, if the economic slowdown turns out to be significant, suspending the QE taper could not be enough to help stock indices, but bonds should gain in such an environment. Yes, so we can talk about that, the Douglas point about big companies' application. Um, I think for the time being, though, the majority of the market really does work on cash and fiat currencies. So the focus would be on that, because the central banks still dominate basically all of the cash supply. This week, though, we have Chinese PMI and inflation from Europe, PMI indices from China. We saw after really poor August readings, temporarily impacted by restrictions that they had because of some resurgence in COVID. Markets hope for an improvement. Inflation in the euro area, France, we had them today. Inflation pickup in August provoked discussion about potential tightening in the euro area, but the ECB has silenced the debate, similar to the Fed. However, inflation is still very relevant for the markets. The economy is peaking, therefore inflation does not slow down. Markets could face problems, because you're going to run into a problem where the interest rate is low, inflation keeps rising, but people aren't earning enough money to keep up with the cost of everything rising. So then the economy starts to slow down again, even though there's easy money supply. Basically, you run into this paradox of money is cheap, but the money that is cheap can't buy you as much. So then you're stuck with less, and that's how the economy starts to shrink again, even though there is. So then you have to either adjust the policy that way at that point. Then tomorrow, finally, we have PCE inflation at 130. So PCE is the favorite measure of the Fed, really. However, it refers to August, so markets may overlook the report. I think it's worth paying attention to these macro reports. Here you can see on the chart the CPI year on year and the CPI core, consumer price index. Core excludes volatile elements, I think. So that's the difference. And you can see that you can see that CPI year on year is spiking above 3% or around 3%. You can see here the highest level before the 2008 crash, really. Almost. Actually, we're approaching 2011. We're around the 2011 territory, but really behind the 2008 crash. And now for the highlight of this webinar, the energy crisis, and I'm sure something that many of you may be paying attention to. If you do enjoy this video, by the way, please feel free to leave a like, and yeah, we're going to continue right along. So, is an energy crisis looming? Looking at this Bloomberg chart here, you can see that gas storage utilization in Europe currently stands at only 74%, with a 5-year average of 89%, so definitely lower than the 5-year average. According to the EIA, if the coming winter will be harsh, then some areas may face commodities shortages. This is currently the case in Great Britain, as many of us may know, where inventories are depleted and the demand continues to increase. Gas prices in Europe and Asia are extremely high. The energy crisis can provoke reaction throughout the whole global market, obviously because it can impact, it has a chain reaction and everything else. Increased demand in Europe and Asia will cause a greater deficit in other markets because supply tends to be funneled there. Higher energy prices point to the prospects of high and rising inflation, so again playing into the inflation, not temporary as indicated by the central banks. However, of course, it will be largely depend on the weather forecast and the weather itself. So winter months, this is something that's interesting if you follow, markets like nat gas or any sort of crop or natural commodity. You'll see that weather forecasts really start to play a role into the prices, because oftentimes, especially with nat gas, let's say, it's tied into the demand, where the colder months or when the colder is, the more heating people require. The less cold it is, the less heating they require. This is the effect of the expectation of higher inflation in connection with the constantly rising prices, but also the withdrawal of funds from bonds investments in favor of strongly rising commodity prices. So we might even be seeing some shifts from the stock market and bonds into rising commodity prices. And really, bonds tend to be often used as a cover for inflation. But if inflation is at 4% and bonds are giving you like maybe 1.5%, then it's not even comparable, obviously. Here we have some more charts from Bloomberg where we can see over the past months, the one on the left, let's take a look at the one on the left first. Over the past months, the prices of energy commodities have increased as much as several 100%. This is the effect of shortages, artificially limiting supply, but most of all, dynamically rebounding demand. Energy prices will affect virtually every aspect of the economy. You can imagine why. If you have any questions about any of this, by the way, feel free to ask. I'll try to get to it as soon as possible. And then we'll move on. So obviously, the rebound in demand, the economy is reopening. There's an increase for demand in fuel, especially with travel back, people moving around, people going to work. All of that, really the issues that we did not have to contend with. Although supply issues might still persist, that's the correlation that we're working with. The correlation between the price of oil and bond yields, so this now we're looking at the chart on the right. The correlation between the price of oil and bond yields peaked since October 2020. High oil prices reflect expectations of high inflation, the prospect of higher rates, and the reduction in the attractiveness of government bonds. High energy prices increase inflation expectations, which leads to higher bond yields. This in turn has a huge impact on the dollar, gold and equities, and especially technology stocks. Hopefully that is clear. Now, let's take a look at oil more specifically. Then we talked about nat gas a little bit. So nat gas for heating really is the main utilization on that end. Oil, I like oil to follow oil because I like to, I find it a little bit easier to follow something that maybe has supply and demand into it, and how that plays. And I liked in these webinars and these events, I like to talk about the correlation between things to make sense of why certain things affect other things, so that when you're watching the news and you see a news about supply shortages about something, you might know, or you might imagine what it might then end up affecting. So I think oil has one of the most basic versions of that, where you can see that basically everybody uses oil in their car and their travels for many reasons. You can easily transfer that into what an impact either extremely high oil prices would have or oil shortages could have. So imagine if we had an oil shortage, what would happen? Obviously, the economy would basically grind to a halt at some point if it ended up being, we got to the point where there was no more oil available. US oil stockpiles are close to dropping to a 5-year low. We can see this on this chart here, or in this graph. In theory, a local low in inventories should be observed at this point of the year. However, not all the production in the Gulf of Mexico was restored after recent hurricanes. So we're having kind of a perfect storm as well happening in markets, where not only increasing demand, where there's an increase in demand, we have a supply issue where the storms basically, I'll mention this in a minute here, but yeah, let's talk about it on this the bullet points here. So Brent tested $80 per barrel or that area, and reached the highest level since 2018. If you are in the WhatsApp group, you might have seen that notification. WTI is trading near local highs at $77 per barrel. Breaking above that would put the price at the highest level since 2014. Goldman Sachs boosted its oil price forecast and now expects Brent to reach $90 by the end of the year and WTI to reach $87 by the end of the year. According to Goldman Sachs, oil market deficit is growing and amid limited supply increases from OPEC and limited impact of Delta outbreaks on demand. So that's something that they were paying attention to, is the spread of COVID along with the increase in demand and the supply. So if you expect more demand in the future, you obviously want to be increasing supply, or at least account for that moving forward. But if you do expect a decrease in demand and you don't increase supply and demand does increase, then you have an undersupply issue, which is similar to what we're running into right now. Moreover, oil supply was hit by one-off factors like the hurricanes on top of everything else. So we had supply issues to begin with because of recovering demand, but then we had also hurricanes hitting supply by having to shut down oil fields and extraction plants. There is a high risk of oil price rallying into year's end amid spike in demand. So as we head into the end of the year, if supply is not adjusted, according to Goldman Sachs forecast, oil market may begin to stabilize in the second half of the year when U.S. shale and OPEC production are adjusted. Markets expect at least some of the Venezuelan and Iranian oil may return to the markets next year, something we've been talking about really. The Iranian oil in particular was a topic that we discussed a year ago at this point, before the U.S. elections, where it was the difference between Trump and one of the differences between Trump and Biden and their policies was going to be potentially Biden making a deal with Iran to restore oil production, so re-entering in the nuclear deal. That didn't happen for the time being, but we did see potential now moving forward for Venezuelan oil and Iranian oil. Yes, so Ahmed asks how you can join the WhatsApp group. So the WhatsApp group is basically a group that you can join by just contacting your account manager, asking them to join just maybe mention you were watching the video, the webinar, and I'd like to join the WhatsApp group. They'll be happy to add you, where you'll be able to receive notifications, including news, updates, some analysis by me, so it's all me, articles sometimes, and really what I try to do is maybe a chart showing some sort of important level that we're at the moment, and some analysis under explaining a little bit what's happening. Obviously, it's not investment advice, it's just information, and I think being informed is a very, very important part of being a successful trader, so that you don't leave things up to chance. Daily reduction in stockpiles around the world sits at record levels as well, so we are seeing this huge reduction in daily stockpiles. Here we have a look at the chart on the 4-hour chart. So this is just a few days old. The oil market, which experienced a big move recently, the price of oil moved above the July peaks and reached the year-to-date highs. However, the upward move was stopped just before $80. This is Brent. Looking at the 4-hour interval, we can see the downward correction reached a key support where the buyers appeared. The green marked zone, so around here, around $77, $77.15, $77.70 is a result of the previous local highs and the lower limit of the one-to-one structure. So you can see basically it's a symmetrical structure over and over again. And a few factors about natural gas once again. You can see that also natural gas stockpiles sit below the 5-year average. So on both ends, we're seeing that. Natural gas jumped above the $6 per MMBTU and reached the highest levels in 2014. Breaking above 640 would leave natural gas prices in uncharted territories. The last time natural gas was so expensive, the US shale revolution was just beginning. Issues with deliveries left European and Asian stockpiles at low levels. Around a quarter of the US Gulf production remains shut following the hurricanes. Production may not resume until next year. Cold December may trigger a spike in the natural gas prices in Europe, Asia, and the United States. On the other hand, should the situation be similar to recent years, a large downward correction may arrive on the natural gas market. So some of it is played into by fears. Some of it is legitimate concerns of supply, a lack of supply moving forward with the increase in demand. Definitely a situation worth paying attention to moving forward. And I'm sure we'll be going to be keeping you updated through the news and through our webinars and our events. So now let's talk about something a little bit different. Some commodities, as I mentioned, that are not as followed. Again, if you have any doubts or questions about anything we've talked about so far, anything you might be interested in, obviously at the end here, I'm going to go back through the chat and take a look at the questions that were asked so that we can go and answer those one by one. You know, as I said, feel free to ask your questions. I'm very happy to answer them. Just wanted to get through all of this so that we don't lose the path that we're walking down. So let's talk about two more commodities that maybe are not as followed, but I think are worth keeping an eye on or are interesting. And the first one is cotton. So cotton stockpiles in the US are very low. Global stockpiles have also dropped in recent months, and you can see this by this chart here on the left. And it's the white line. You can see the white line dropping. These are global stocks. So situation on the cotton market starts to resemble 2010, a breakout from a similar trading range as in 2008, 2010 occurred. Seasonal patterns suggest that the bullish momentum may strengthen at the beginning of November. Seasonal patterns are important for raw materials like this. Cotton price sits at the highest level since 2012. Weather conditions in the US are far from perfect for cotton. Large rainfalls could be spotted in Texas and Mississippi River Delta. Cotton demand is picking up in China. Demand from Thailand and Turkey is also strong. and we have a noticeable reduction in the number of open short positions while open interest continues to increase. It is expected that this year's deficit will continue into 2022 as well. We're really sticking with the same theme of undersupply at this point, where there are supply shortages across several commodities, and we are seeing them reach the highest levels in years at this point with price-wise. So that's very interesting to keep an eye on that level. Secondly, let's talk about aluminium. Aluminium, interesting metal, really. Stockpiles on the LME have dropped, so you can see that here. On this chart on the left, situation in other parts of the world looks similar, and we are seeing this basically globally. China plans to release parts of its strategic base metal reserves, including aluminium, in a move aimed at lowering prices. This is something that happened really at the beginning of the pandemic. We saw where China was one of the first, if not the first country to recover or start to recover. And what they were doing was, while everybody else was closing down, they were buying raw materials. So they were buying copper, oil, nat gas, aluminium, silver, gold. They were buying everything they could buy because everybody was selling it cheaper than it was. But now we are at a point basically where they've accumulated so much of it that the Chinese government is worried that if at any point somebody decides to sell a huge quantity of it, it could cause a price shock. So what they're doing now is forcing companies and storages to get rid of some of their strategic reserves to avoid a huge price drop, but also to drop the price at the moment by increasing supply because they have such an oversupply at the moment. Aluminium production in China is becoming a problem amid new environmental policies. So we're also seeing that where environmental policies that might have been, out of reach or maybe not considered for China just a few years ago are now moving in that direction. We're seeing a huge increase in electric vehicle interest, which has led to an increase in demand of precious metals like palladium and platinum, along with silver. So those are some I talk about often. That's something moving forward worth keeping an eye on is these precious metals or these metals that have strategic uses or operational uses in the future technologies. So, some precious metals are used in microchips. Some precious metals are used in the batteries. Some precious metals are used to conduct electricity. And all of the above really is going to be playing into the future of construction of cars, of vehicles, of where we're headed with technology, where it's going to be all about really electrical, it seems, because of the government policies and environmental policies. Post-pandemic economic recovery suggests that aluminium stockpiles may continue to fall, though, so as demand increases. And if we look at this excitation chart here at the bottom, aluminium trades around 13% below all-time highs. On the other hand, prices have dropped recently amid plans by China to release some of the strategic reserves, so increasing supply. And that is all for the slides, the Trading Club webinar. Let's get to the Q&A section. I like this section a lot, so let's start getting through some of your questions. Hopefully you found these slides useful. I tried to cover a lot of topics. I understand that maybe it was too much. I hope you hung on or held on to the things that maybe interest you the most. I can understand that maybe you don't follow everything, but I like to give it a general overview so that everything kind of fits in the big picture, because the bigger the picture, the more you understand how one thing plays into the other. And I find that very interesting. I think it helps when you trade as well. So obviously on the X station you can have you can compare charts, so you can have multiple charts on the same chart showing you different candles and seeing how they relate to each other and how they move. So now, if you have any questions, please feel free to ask them about anything we talked about today, anything that you might be interested in. And if you want me to take a look at some charts, we're going to be heading over to the X station to take a look at some charts, starting with the DAX, because I remember that was one of the first questions. So thank you very much for everybody who's been here with us so far. If you enjoyed the video so far, feel free to leave us a like, subscribe to the channel. It really helps. So let's talk about some questions now. So if you have questions, start asking. I'll get to the ones at the back. So if it's about your account or money, feel free to contact your account manager. They might be able to help you more than I am. But if it's about markets or analysis, I'm the guy. So Shahid actually was, I think, one of the first people who asked about a gold forecast. So for that, let's take a look at the X station. I already have it pulled up here. And what is this? This is oil. So you can see this huge jump with a pullback at the moment. We're going to talk about this in a second, actually. But gold jumping up around $40 almost from the lows of today. I like to basically take a look at the chart. You can see the way I do charts is really, first of all, I set, a range, let's say, and then I look closer and closer. So I have an Ichimoku cloud on top as well. You can see it acted as a resistance several times, but breaking through it was a huge deal. And actually, if you look at the market news section on the platform, you'll see the price that we actually just released an article on this. It was a notification, and it was just about this. The upward move was started, or the upward wave was started right after the release of US data, which was rather mixed. Some analysts believe Powell's speech before Congress may have changed a lot. Today, the second day of the hearing takes place. Evidently, the Fed chairman softened his tone a bit compared to Tuesday's hearing. What this means is basically they are now talking about potentially changing monetary policy, shifting basically the supply of money from stocks into precious metals as they potentially drop. Now, that's not going to happen overnight, as always. Let's take a look at it technically, though. So technically speaking, we have tested this support twice, this area which acted as a support low, basically of the month. So the lowest level since August, twice before rebounding significantly. But where are we now? We are at the top of the range. So this area here, you can see that acted as a support and a price reaction area in the past. This area that was tested around 1762, maybe 1760. You can see how many points it touches, and you can see that it acted as a resistance. Now the price is heading back down, but if we do put a level this way, we can see that we are stuck within, or we are at the moment hovering within a very narrow range of about $5 to maybe $10, let's say. And for the time being, we could be seeing some movement in this area before any further movement breaks through that. Because then past that, we do have this other high, which is a similar situation to this one, really, around 1787. But we would have to see some significant changes as well on that end, fundamentally. On the chart at the moment, you can see this area has acted as a resistance, this area has acted as a support, and the price is hovering between them. But after the pullback, you can see some green candles with the latest red one. So let's see where this one closes. That could be an important factor, because if this area can hold, perhaps this could be the next support where we are holding for the time being. But if we do break through it once again, we could see maybe the price continue moving in some other direction, of course. Okay, that's just a general overview. Of course, we're trying to keep it away from investment advice, so I can't really, obviously, and I don't know the future, but these are the things that I tend to look at. So I try to look at resistance, support, take a look at where we are, analyze the fundamentals a little bit, and then wait for confirmations on whatever you're doing. Let's see. Douglas asked earlier about, actually, so Sufyan asked, along with Douglas, asked about DE30. So let's talk about that. So this is the DAX, German DAX. Same thing, same principle. You'll see that, interestingly enough, as long as I put the lines on the lowest areas, you can see that it actually oftentimes get tested several times. So for the time being, we are testing a previous support from just a couple of days ago after two attempts to reach a higher high. So we saw, okay, let's break it down a little bit more, actually. So let's actually take it even on the 4-hour chart so we can see some major moves. Because what they're saying is correct. There have been a lot of moves, and they started quite strong with this week. So a lot of them are related to fundamental factors. So what is happening really in markets? It plays into what we talked about earlier. We saw the Chinese situation, which is this. So this drop here was coincided with almost 5%, 4.75%. Coincided, actually it's almost 5%. Coincided with the news of the Chinese company defaulting on their debt, or potentially not being able to pay their debt. Then what happened? We saw that news, improve. So the prospects of that improved. As I said, they were issued 30 days of leeway to accumulate the money. Some potential rebound towards the start of the week, and then we had the whole energy crisis situation, which you always have to think of how people perceive these events. So even if, let's say, how markets sometimes actually perceive these events. So even if, let's say, you might not be worried about not having oil because maybe you go to work or you mainly use public transportation, the economy as a whole is really tied to each other with these kinds of things. So the way markets see it is, if this continues, we go back to the logic that I was saying at the just a few slides ago on towards the end of the presentation, where what if supply gets slowed because trucks don't have oil anymore to travel, so then raw material or components for other things are no longer available, and so on and so forth. As chain reaction. So they tend to make a big deal into a way bigger deal. And also, as I said before, the more unexpected something is, the more it could have an impact on markets. So we are seeing the effects of fundamental factors principally affecting markets, along with outlooks of the potential central bank changes. So really the two events that I talked about, or the three events that we talked about today, are really all playing into what we are seeing in stock markets, being the oil or fuel energy crisis potential. I call it crisis, but really it is not yet a crisis. The central bank policies, which this week we had the speeches, last week we had the decisions, and we have the Chinese Evergrande situation. So these are playing. Technically speaking, as I said, we are testing a previous support, not super strong, but something that is worth noting. Around 15,200 points is basically where it's located, and it's interesting to note that it is around a psychological level, as they're called. So let's say round numbers tend to be considered psychological levels, like 15,000, 15,500, and so on and so forth. I'm glad this helps, by the way, the whole understanding the situation, how we do the correlation. That's what really my main objective is. So let's see. D30, US 30 as well. Let's take a look at US 30. I think the same logic really applies, but let's take a look at it anyway. Let's see. You can see 4-hour chart now pulling back on the indices as well. This is also related to the central banks, oftentimes, so related to central banks. So for those of you that don't know, the US 30 is the Dow Jones Industrial Average Index, and it usually has companies that are more on the manufacturing side, rather than maybe the NASDAQ, which has more tech stocks, and the S&P, which is more broad and might have the biggest companies that you might know. So really tied to supply and demand and production. The US 30 is suffering at the moment. We can see we are still moving sideways in the big picture, and really even in the bigger picture, if we go on the daily chart, we can see this is where we're at. So this way, it looks like we've dropped a lot, which we have. But if you look at it this way, it still looks like it's going upwards. And in fact, if we do draw a trend line, maybe this way, you can see, I like to make it at least touch 3 points. That usually is good enough. And we can see that right now we are actually testing on the daily chart the trend line on this that goes on from basically the beginning of February. So, and it's managed to hold so far as a support. But if we put it another level on top, like this maybe, you can see that we are roughly in an upward channel still. And you can see it's really straight up from 2020, even though at the moment it looks like we're really heavily correcting. It is a significant drop. Obviously, this is on the daily chart. You can see how many red candles there are. But how much is this drop? About 4 or about 5%. And we're still around these areas, which, as I mentioned in the past, some of these valuations, practically speaking, don't make much sense. So a correction sometimes can be natural. Next question. Again, if anybody has any question about markets you'd like me to talk about or anything like that, feel free to ask them. This is what this is for. I'm here to provide as much, usefulness and content as possible. D30, let's take a look at something else. So Patrick says, I foresee another huge recession far worse than 2008. We all know, we as individuals, we can't keep borrowing money, which the government with their central banks has done. That is an interesting perspective. I think that there is a point of view that is valid there, where Obviously, the government and individuals cannot keep borrowing money. Although I would. So we could see something different, I think. So what we could see different is the fact that this time there was a lot more support for the average person, rather than in 2008. In 2008, it was really based on a series of financial institutions and financial issues with really technically were crimes, where they were selling debt that was, or they were selling assets and debt that was, as they called it, junk debt, so that it was never going to be repaid knowingly, which is obviously not a good thing, because then at some point we have the situation where like a scaling of the Evergrande situation, basically. But I don't think, or we have to see basically if the Chinese government lets it happen, because the US government, what they did in 2008 was bailed out all the companies that were issuing the debt, but then the individuals that were taking those loans to then buy houses that were cheap and then couldn't pay them back, they got kicked out of their houses. So that led to the huge economy cycle where the economy crashed. But this time, I think that the valuations of the indices for sure are inflated, because we've talked about this in the past, where if you look at price to earnings, price to sales of the stocks individually, you'll see that it does not warrant this huge increase. Also, the index in itself, as I said, is weighted in a certain way where some companies, like for example, just imagine the S&P 500, and imagine that like the FANG companies like Facebook, Amazon, Netflix, Google, all of these companies that are Tesla, let's say these make up the majority of the weight of the index. So let's say the top 20 companies you can think of all make up the majority of the weight in the index. So if they perform well, which they have, they do well. However, they are only one sector of the economy, which in a previous webinar we did was the whole topic we were talking about of stocks that were good before the pandemic and stocks that hiked or spiked after the pandemic. So we saw a lot of tech stocks spiking. We saw Zoom, obviously, a lot of us started using Zoom. Anything you might imagine that really became more in demand during the pandemic, Netflix, those stocks really benefited heavily. And while, airliners, traditional stocks really suffered the most, airline companies, hotel companies, production companies that couldn't produce, all these things really suffered the most. So what am I leading with this? The idea is that once inevitably the monetary policy changes, that's going to be the moment of truth where we're going to see how the markets react to not having that oversupply of cash anymore. Because for sure, some people do need it. So some industries definitely need the cash. The problem is that a lot of this money is going into stock market, and it is inflating the price of stocks, it is inflating the stock market, and it is inflating indices. So perhaps, could we see a crash in the stock market? Potentially, maybe. But I don't know if we're going to see a crash of the whole economy where millions of people lose their jobs or something like that, because we're coming out of the pandemic and COVID and the regulation that was put in place. But, this is all speculation at this point. I just think that based on what we've covered in the past, based on the news, the key factors playing into that are going to be, as I said, central banks, so interest rates and fiscal policy with the QE, quantitative easing, along with the recovery in demand, and obviously keeping inflation in check. So these factors are going to play a huge role. Could we see a drop? I think that it will be focused on the, if there is one, it could be focused on the stock markets, not necessarily on the real markets. We also have obviously cryptos nowadays, which were not around really 13 years ago. So the situation is slightly different because a lot of people are starting to diversify into that kind of stuff. So that's going to be an interesting situation. It's a really complex topic, but I think it's very interesting, and I appreciate when you have a theory about this. Douglas said, big companies' application to deal in crypto, so there's funds less controlled by governments. True, but also it's not the only reason. Traditionally, companies do diversify, and they try to hold money in different assets, which tend to be a way to keep in check with inflation as well. So obviously bonds are not are not in line with inflation. Gold is really on average performing quite negatively. If you look at the asset of gold over the last 10 years, it has not performed very well. So a lot of investors, institutional investors, you'll see in this, especially more recently, are hedging by really investing some in crypto. And I think it, of course, some regulation, but I do fully expect basically the regulation to catch up with cryptos at some point, at least on a on the day-to-day level, on the sense of day-to-day use maybe in an economy. And I think that institutions are expecting that as well. So I don't think that necessarily in the long run they're heading into crypto to avoid regulations, because they already do that now. They already evade taxes and dodge and open offshore accounts and do all this stuff that they can do. So I don't I think more likely a reason for crypto investment of cryptos or for cryptos from companies has been the diversification into something that really statistically has proved to be over the last 10 years a better return than many other things, but might not continue to be. So maybe they invest all their money or a lot of their money in cryptos and then they tank. I don't know. Really, that's the situation that we're heading into. But there are multiple reasons and multiple theories. I don't claim to have the answer. Yes, so Douglas says 130% loans on housing back in the US, or back then in the USA. Exactly. Thank you, Sufyan. Thank you, everybody who has joined us so far. What time is it? We're almost at 7 o'clock UK time, so maybe couple more questions and then we can close this webinar out. We'll be going for about an hour. I do enjoy these, so hopefully you enjoyed this as well, found it useful. So we talked about, Ahmed asked about the Dow Jones. We talked about that a little bit. We talked about gold. Douglas asked, do you see a small recovery in the near future? As I said, so this is the Dow Jones, but let's take a look at the DAX in a second. Thank you very much, Waldemar. Thank you very much for being here with us. I really appreciate it. Hopefully we'll see you at the next one. Hopefully you enjoyed it and found it useful. Have a great evening and good luck with your trading, of course. So this is the DAX. As far as a short-term recovery, what would that depend on, really? We have to follow the news. We have to follow the support level we're at the moment, or potential support. We are at an important level. This is the 4-hour chart. Let's take a look at the 1-hour chart. You can see we are testing a previous support. I feel like this is going to be an important moment because obviously we can have multiple situations here. We can have it move sideways, in which case we are still down. We could have it try to rebound, head for the upper limit of the trading or the short-term trading range, or we could have it break the previous support and continue maybe even the downward move. But then we are down. Obviously, the next lowest level is around 15,000 points. As I said, psychological level, because it's a round number. And really, moving forward, that's going to be dependent on this, really. This level that we're watching at the moment is a level that I would send on WhatsApp, for example. This is how I look at charts, really. Sometimes when I write a WhatsApp message, this is what I look at, is look at this level. Thank you, Douglas. I appreciate it. So this is a level that you might want to be taking a look at because obviously it has had previous reactions in the past. We are seeing that it is the lower limit maybe of a potential trading range if I draw it this way with a top limit here and a lower limit here. And once we see what happens here, then we can form an opinion of whether a recovery can happen. But for the time being, what we are seeing with this 1-hour chart is that the downward move, even though there were 5 red candles, has not yet continued into below this level. In fact, this is a green candle. We should be waiting to see what happens after this one. Any other questions? If anybody has any other questions, final questions before we close up the webinar. Hopefully, again, you found this useful and enjoyable. We did talk about a lot of things. We've been talking about the charts as well. I'm trying to look for previous questions that maybe I have missed. So, Shahid asks about the current position of HK Comp, so the Hong Kong Composite Index, and we will take a look at that in just a second. As you can see, this is an hourly chart. The index is testing right now the 200-hour moving average, which I think is something worth having on the chart. Sometimes a moving average can be quite useful. But if we take a look at, let's let's start with this chart and draw some lines this way. So let's draw a range, maybe this way or even up here. Let's do it here. There's so many points here. So we're basically moving sideways at this point. However, if you take a look at this, we have had several higher highs and higher lows until these sideways move at the moment. So similar situation to what we're seeing in European indices, really tied into what's happening with the policies, government, the Chinese government, as I said here, you can see here, oil surges after China ordered energy firms to secure supplies at all costs. The Chinese authorities issued a recommendation to energy companies to secure the supply of raw materials at all costs. That could play positively into stocks because obviously the fear of losing oil supply could then impact stocks negatively, while the being reassured that they maybe have supplies even despite the shortages otherwise in other parts of the world. That might be reassuring stocks. But what we are seeing actually, and we can draw it differently here, is this way, basically. A flag, almost. So if we draw it, let's say this way, and then we put a line on this side, you can see that the line really is heading upwards, and most importantly, it is narrowing in volatility. So that is something that you want to be seeing in a flag. And once we get to this side, to this end, basically, that's where the important part starts, where we have to see if the index breaks below the line or breaks above this area. But even if it does break above this area, you can see that there is quite some room to get back to the top. We have been dropping significantly over the last few weeks and even over the last few months. So Chinese stocks slowing down, but at the same time, for the short term, we can see they have, after reaching this low, they have been heading upwards on the hourly chart at least. So this area, an area worth keeping an eye on. Hopefully that illustrates the point. Anything else before we close? If anybody has one, maybe a final question or some final questions. If not, we can also end this webinar. I'm glad you enjoyed it, whoever did. Thank you, obviously, everybody who just joined us. If you'd like to join future events, not miss out on them, check your emails. Of course, I'll send them on WhatsApp. If you're not in the WhatsApp group, feel free to contact your account manager and we'll be happy to add you. Again, if you have any more questions or any doubts, feel free to ask them now. Hopefully, we covered a lot of things today, so maybe I can understand if there's not that much left. I understand there could be some delay, but let's just double check. Okay, so if nobody else has any, thank you very much for, thank you, David. Thank you, Shahid. Thank you, everybody who joined us. Let's just end it here, I guess. I think it's a good point. It's about, we've been going on for about an hour, covered a lot of things. I'm really looking forward to the next one as well. So, I'm sure we're going to have a lot of things to talk about even in the next one. Obviously, today was very specific, but also broad because they all tied into each other. And they're all major events with, as I said, worth keeping an eye on moving forward. Keep an eye out for the central banks. Keep an eye out for the energy crisis. So oil prices, natural gas prices, supply and demand. And keep an eye out for the Evergrande situation moving forward throughout the month to see just how that plays out. So actually, one final question, because I just saw this. Leslie asks, what impact to the economy the shutdown is halted? So I think I think the way I understand this is, so they avoided the shutdown basically. So how is that going to impact the economy, right? I think that is how it is. If that's the question, then obviously the shutdown of an economy, especially the US, could have huge impacts on several other sectors because you're shutting down a lot of government institutions, you're shutting down a lot of government programs, you're shutting down a lot of things that the government is involved in. So that would end up having a negative impact on the economy, of course. However, on the flip side, we also did talk about, to that point, we also would have seen potentially a downgrade of US debt rating, but that's unlikely to happen for the time being. So the reverse of that is basically a positive impact, of course, for the short term. Because if you read the news, and once more, I will refer to the news section of the website, you can see here we have a huge article based on this very topic of the government shutdown. So yesterday, however, information was released that an agreement has been reached to extend government spending until the 3rd of December. So that's the thing we need to see at the moment. This whole issue of the debt is also tied into the $3.5 trillion infrastructure bill that they're trying to pass in the US. They are intertwined. So how that situation is going to play out is really going to depend on the negotiations between the Democrats and the Republicans, because we all well know that the US does have $3.5 trillion to spend on infrastructure. They spend a lot of money on a lot of things, and they have the biggest GDP. So it's just an issue of, technically speaking, it probably is just an issue of reallocating budget. Now, priorities change because not everybody in the US sees it the same way. Of course, they are quite divided. But one thing that they probably will be agreeing on is the fact that a shutdown of the economy will probably be negative. Now, I think both parties might use that as leverage, as a bargaining chip of don't make us shut down the economy by not agreeing, so compromise with us, and they'll see who's more scared of the economy. It's kind of a bluff in that sense. But I personally feel, based on really history, let's say, that probably the Republicans are more willing to go through with that, while the Democrats will probably cave at some point. You never know, but that's kind of how it's played out so far. So obviously, if the economy isn't shut down for the time being, we'll see, if the government isn't shut down for the time being, that won't play that much of an impact. But as the date nears of the 3rd of December, now the next date, then markets might be more nervous because it goes into Christmas and Christmas break, and if they can't reach an agreement, then it has to go after. So it really gets delayed quite a bit, and then that can have a spiraling effect. So hopefully that answers your question. I tried to cover it as best as possible. It is quite a complex issue, but I feel like that was roughly just the general idea. So thank you very much, everybody who joined us today. My name again is Walid Koudmani, market analyst for XTB. You can find me on the WhatsApp. So if you like to join the WhatsApp group, hopefully you enjoyed this video, and I'm sure we'll be doing more of these coming up. So if you have any sort of topics you'd like us to discuss, of course, we'll be covering main events and what's happening. But if you have anything in specific, feel free to get in contact with your account manager next time you talk to them. Just let them know, hey, I would like to maybe have a webinar about this, or a focus on this or that. So thank you very much, everybody. I think it's time now. So have a good evening. Good luck with your trading, and I'll see you all at the next one. Thank you very much.